Bismillahirrahmanirrahim. In the previous class, we discussed about financial statements. What are financial statements? This one. Then after that, we discussed about statement of financial position. Then we discussed about income statement. Then we discussed a bit about statement of changes in equity. I told you about statement of changes in equity is just like what is the position of the owner's equity or what is the position of partner's equity or what is the position of shareholders equity, whether there is increase in the equity. If it is sole business, so it will be owner's equity. So there is increase in owner's equity or there is decrease in owner's equity. If it is partner's equity, means it if it is a partnership business, so whether there is increase in partner's equity or there is decrease in partner's equity. And same is the case of shareholders equity. So we will check whether there is increase in shareholders equity or there is decrease in shareholders equity. So shareholders equity, so changes in equity, it is a statement which just tells us about the changes in the position of equity, whether it is increasing or it is decreasing. So here, statement of changes in equity, also known as statement of retained earnings, it is in joint stock companies, statement of retained earnings, details the movement in owner's equity over a period. So it just tells us about the movement in owner's equity, increase in owner's equity or decrease in owner's equity. The movement in owner's equity is derived from the following components. We discussed about these components. Net profit or loss. You know, owner's equity, it will be increased if there is profit, and owner's equity will decrease if there is a loss. You people already studied this thing in balance sheet. In balance sheet, there is owner's equity. If there is profit, so we are adding profit to the owner's equity. And if there is a loss, so we are deducting the loss from the owner's equity. Then share capital issued or repaid during the period. I told you about this thing. If you are issuing new shares, so capital is coming into the business. Like suppose our previous capital, it was $100,000. Now what company did? Company issued additional 10,000 shares. And the price of one share, it is, suppose it is $2 per $2. So this thing shows 10,000 multiplied by 2. We issued 10,000 share and the price of one share is $2. So mean the company received additional $20,000 capital from investors, from shareholders. So this 20,000, it will be added to this capital. So there will be increase in capital. But if the company is redeeming shares, mean the company is taking back shares. There is a kind of share that you can buy it back from the shareholders. We call this process redemption of shares, calling back shares from the shareholders. Suppose that is that type of share. We received $20,000. Now what are we doing? We are, sorry, this was 20,000. So it will be 1,20,000. Suppose we purchase these shares back from the shareholders. So this $20,000, we are returning this money to the shareholders and we are taking our shares back. I'm telling you, there is a kind of share that you can buy it back from the shareholders. So I'm just talking about that one type of share. So if there is redemption, then we paid $20,000 back to the shareholders. So what is left? 100,000, means we return the equity to the shareholders. So this is redemption and issuance of shares. Issued or repaid during the period. Dividend payment. If you are paying dividend to the shareholders, so your equity, it will come down. Suppose 1 lakh is our shareholders equity. This year profit is suppose 40,000. So out of 40,000, what we did, out of this 40,000, we paid 10,000 to the shareholders as dividend. You know, shareholders are investing money for this thing, for this dividend. So we paid this 10,000 to shareholders. So 1 lakh plus 40,000, it is 1,40,000, our total equity. But since 10,000 is paid back, $10,000, it is paid back to the shareholders as a dividend. So we will deduct this from shareholders equity. So now how much of the shareholders equity will be left? It will be 130,000. So if you are paying dividend, so this is reducing their equity. Just like in sole business, if owner is withdrawing money for personal use, so it is reducing the owner's equity. Same is the case here. Gains are losses recognized directly in equity. Revaluation surpluses. We discussed about this revaluation surpluses in the previous class. Basically, this revaluation surplus, suppose sometime there is a stock, suppose we purchase bonds or shares, and we reevaluate these assets or bonds, and there is gains or losses from the revaluation of these shares and bonds. So we will add if there is profit on these that revaluation, and if there is a loss on that revaluation, then we will deduct it from it. Take an example. The company invests money in bonds and shares. Suppose they invested $10,000. We invested $10,000 in bonds and shares. But when we reevaluate it after 1 year, you know, the prices of shares and bonds, it can go up, it can come down. So after 1 year, when we reevaluate it, so the value of these shares and bonds today, it is 12,000. So there is a profit of 2,000. So it will increase shareholders' equity. But if on revaluation, suppose the value comes down to 9,000, the market value of these assets, it is now $9,000. So in this case, now there will be a loss of 1,000, and that loss of 1,000, it will be deducted from shareholders' equity. Effects of change in accounting policy or correction of accounting error. There is some mistake in the previous year, accounting error, and now we are going to adjust it. So it will affect on the shareholders' equity. Or there is change in accounting policy, and because of that change in accounting policy, it will affect the company, it will affect the profit position, it will affect the when it will affect the profit position, so it will affect the equity position as well. Now I'm telling you that if there is some accounting error in the previous year, we now identify that there was an error, so that error was affecting our owner's equity. So because of the error, if there is an effect, if there is an impact on the profit or loss, so it will also affect the owner's equity. So now what we did, we adjust that thing. We will adjust that thing in the current period. Same is the case here. If there is change in accounting policy, and because of that change in accounting policy, there is some impact, so we will also adjust that impact. Now here is the explanation of the components of the shareholders equity statement or changes, statement of change in equity. Following are the main elements of statements of changes in equity. The first component is opening balance. What does opening balance means? This represents the balance of shareholders' equity reserves at the start of the comparative reporting period as reflected in the prior period statement of financial position. Now, what does it mean? This is 2018. In 2018, we made a statement of equity. This thing, statement of changes in equity in 2018. And we got here a closing balance. That this was the closing balance. Suppose it was 100,000. So this is what? This is the closing balance of 2018. Now in 2019, when we will make statement of equity, so here in 2019, this closing balance will be the opening balance in 2019. So we will take start from this opening balance. So he's talking about this thing. The opening balance is unadjusted in respect of correction of prior period errors rectified in the current period, and also the effect of changes in accounting policy implemented during the year, as these are presented separately in the statement of changes in equity. Now keep in mind this opening balance. In this opening balance, we discussed here that there can be some changes in accounting, there can be some accounting mistakes, accounting errors, or there can be some changes in accounting policy. But in this balance, in this opening balance, that thing is not included. So if there are some mistakes, so we will adjust it here. Now the second thing is changes in share capital. It is also affecting the statement of changes in equity. Issue of further share capital during the period must be added in the statement of changes in equity, whereas redemption of shares must be deducted from therefrom. Now I told you, if you are issuing new shares, 1 lakh, it was our closing balance and opening balance of new year. Now suppose we issued additional shares, 10,000. So we will add it here. And if there is redemption of shares, so we will deduct it from the opening balance, this one. If new shares are issued, so mean more equity is coming to the business, so we will add it. And if there is redemption, means we bought shares back from the shareholders, so that means we are paying the money to the shareholders, so then we will deduct it from the shareholders equity. So he's talking about this thing. Whereas redemption of shares must be deducted therefrom. But if there is redemption of shares, means shares that we issued, we bought these shares back from the shareholders, then in that case we will deduct it from the opening balance. Dividend payments issued or announced during the period must be deducted from shareholders' equity, as they represent distribution of wealth attributable to stockholders. If you are paying dividends to the shareholders, suppose out of the profit we paid 10,000 to the shareholders, we announced dividend, we paid dividend, so this money will be deducted. Dividends must be deducted from the balance. Income loss for the period. This represents the profit or loss attributable to shareholders during the period as reported in the income statement. Now if there is profit, suppose this year there is a profit of 50,000. So now this profit will increase our shareholders equity. So 1,10,000 plus 50, it becomes 1,60,000. But if there is a loss, so loss will be deducted. Profit, we are adding the profit in shareholders equity, but if there is a loss, that loss must be deducted. Other gains and losses, any other gains and losses not recognized in income statement. If there is a loss or profit, we didn't include it in the income statement, may be presented in the statement of changes in equity, such as actual gains and losses arising from application of International Accounting Standard 19, which is regarding employee benefit. So that type of gains and losses that we are not showing in the income statement, we will add or we will deduct. If it is gain, we will add it in the statement of shareholders equity, and if this is a loss, then we will deduct it in the shareholders equity statement. And the last thing that will come will be the closing balance. Suppose there is nothing left, so this will be the closing balance of this year 2019. So all those things that are affecting the shareholders equity, if it is increasing the shareholders equity, we will add it, and if it is reducing the shareholders equity, sorry, we will deduct it. So closing balance, this represents the balance of shareholders' equity reserves at the end of the reporting period as reflected in the statement of financial position. So this will be the last item, that is what? The closing balance. Purpose and importance. So statement of changes in equity helps users of financial statement to identify the factors that cause a change in owner's equity over the accounting period. Now this statement of owner's equity, it will tell us in detail about each and every item which is affecting the equity. In detail, I'm telling you, in detail, this statement of owner equity, it will tell you in detail that due to which things there is increase in owner's equity and due to which things there was a decrease in owner's equity. Whereas movement in shareholders' reserves can be observed from the balance sheet. Statements of changes in equity discloses significant information about equity reserves that is not presented separately elsewhere in financial statements, which may be useful in understanding the nature of changes in equity reserves. Now, changes in equity reserves, we are showing it in the balance sheet, but it is just one item. There is no such explanation like this. Like I told you that this is opening balance, then we add new shares issued, then we deduct dividend payment, then we deduct then we add profit, then there is some other income, increase in income due to some other items. Not such explanation in the balance sheet. So in balance sheet, we are just showing one item, changes in reserves. But in statement of owner's equity, we are showing all these things. So examples of such information include share capital issue and redemption during the period. Now this thing is not mentioned in the balance sheet. Share capital issued and redemption during the period. The effects of changes in accounting policy. This thing is not mentioned in balance sheet. Correction of prior period errors. Gains and losses recognized outside income statement. These things are not mentioned. Dividends declared and bonus shares issued during the period. So all these information are not included in the balance sheet. Yes, in the balance sheet. We are providing all these information in the statement of changes in equity. Statement of changes in equity. So this is the purpose and importance of statement of changes in equity. So the purpose of statement statement of changes in equity is this, that it gives us a detailed information about the statement, detailed information about changes in equity, whereas the balance sheet is not providing us such detailed information. I think for today it is enough. Inshallah, in the next class we will discuss about cash flow statement. I will check the length of the video, then if there is time, so we will discuss about this opening paragraph. Okay, we have time. So the next statement, it is cash flow statement. Cash flow statement presents the movement in cash and bank balances over a period. It is just giving us information about the changes in cash and bank balances, nothing else. It will tell us just about changes in cash, how much cash is coming, how much cash is going, nothing else. The movement in cash flow is classified into following segments. 3 segments. We are dividing the statement of cash flow into 3 segments. The first one is operating activities, represents the cash flow from primary activities of the business, the main activities of the business. Take the example of Salam University. So what is their main activity? Their main activity is providing educational services. If there is a cement factory, so what is their main activity? Making cement and selling it. So that is main activity. Inshallah, in the next class, we will discuss about this in detail. Investing activities. Investing activities represents cash flow from the purchase and sales of assets, other than inventories. Inventory is coming here in operating activity. But in investing activity, we are concerned about the purchase and sales of assets. It can be fixed assets. It can be other assets like bonds and shares and these things. These are also assets. So here we are concerned about the purchase and sale of assets. Like here is an example, purchase of factory. And the third one is financing activities. So you know about financing, represents cash flow generated or spent on raising and repaying share capital and debt together with payments of interests and dividend. Here we are concerned about raising finance, getting money by issuing bonds, by issuing stocks, taking a loan from a bank, are such activities, are repayment of these things. So financing is what? Raising finance, or repayment of that finance. Raising finance through debt or equity. And repayment, you know about repayment. So inshallah, in the next class, we will discuss about this cash flow statement in detail, that which things are coming in this cash flow statement. So inshallah, in the next class, then we will talk about this in detail. Have a good time.